Good morning, everyone. Welcome to this update for global stocks and commodities for the 16th of July. The week ended with a real bang. The US market shot up to another all-time high, and basically we've got continuation of an environment where it's pretty hard to see what is going to cause any sort of significant correction in the stock market. There's a lot of very solid fundamental reasons why the market is going up. Now, sure, there are some parts of the market that are overvalued, but just avoid those sectors. There are plenty of sectors that still provide very attractive valuations relative to the growth in those stocks. So let's take a look at what happened last week. And in this edition, I'm going to be looking at what's unfolding that may be forcing the Fed to perhaps change their course on raising interest rates. A couple of things happened during the week, and what the impact that is for stocks and bonds, commodities and currencies. So basically, all asset classes. What sectors are currently being supported? What all this means for gold, silver, and oil. And also, too, I'm just going to take a look at the European indices, and there's quite a strong correlation between the German DAX and the American S&P. It's a very high correlation. So one is sort of reinforcing the other at the moment. So let's get into it. American stocks, the S&P index was higher by 35 points, with quite a bit of that on Friday night as the index broke out of a small consolidation pattern that had been the case for a few weeks. And that was largely because two things happened last week. First of all, Yellen's testimony to Congress certainly pointed to a bit of a softer stance on raising interest rates, the rate at which they may raise interest rates. So that kind of set the scene on Wednesday for for people to start to think differently about how the Fed may approach things. And then so the economic data came out on Friday, which really was weaker than expected, both from a point of view of inflation and jobs, and also retail sales. So things perhaps not zinging along as well in the US economy as some thought, and of course that then raises the issue: does the Fed slow down their rate of interest rate rises, or in fact put any further rises on hold? So there's definitely the possibility. It's a bit early to say because it's just one set of comments and one set of data, but certainly the expectation the market had for a very significant rate of interest rate rises may not necessarily be the case. And as a consequence, the US dollar fell sharply. Stocks absolutely loved it because the punch bowl was getting refilled again. And in particular, technology stocks, which had been sold off on the basis of higher interest rates, and I can't explain that. That doesn't make any sense to me. I understand the relationship between higher interest rates and high levels of debt, but a lot of these technology companies have got no debt and just tens of billions of dollars of cash on their balance sheet. So I didn't ever understand the sell-off in technology in the first place. But nevertheless, technology surged back very, very sharply. And the 50-day moving average, excuse me, the 50-day moving average continues to provide support to the S&P index. Synchronized global growth, I think, is really the big underreported story. Just about every economy around the world is ticking along quite nicely, and certainly some of them, the growth rate is starting to accelerate. So I think that's the big story that the media hasn't really picked up on yet. And that's what's really supportive of stock values. Now, we've also just had the US earnings season kick off in the last week, and 3 or 4 of the major banks in America reported. They all exceeded consensus expectations. The market reaction was initially a bit negative. The US financial stocks gapped down on Friday on the opening, but they continued to rise throughout the session and finished on their session highs. And really those results were pretty solid when it's all said and done. So let's take a look at some charts. We'll start with the S&P. Let's just take a big helicopter view. There we go from the bottom in 2009. And you can see that other than a period here in 2015, 2016, the 200-day moving average has continued to rise at pretty much a similar rate all the way through. There's really no change in the rate of ascent of the S&P. So you'd be a brave man to say that this market is topping. That is just wishful thinking and guessing. And you can see that over the last period, that certainly the S&P index has continued to just basically hug the 50-day moving average line as that's about as far as it wants to pull back, which is only about 2 or 3%. So we've advanced to new all-time highs in the S&P, and of course that'll bring out another chorus of where's the market going to top. But I think you'll be well advised just to stay with the trend until that trend ceases to be. Let's look at the Nasdaq. That had got a little bit shaky over the last couple of weeks. For reasons that I explained, but you can see the Nasdaq bounced back quite sharply from around 5,600 to in excess of 5,800. So that was a very powerful week for the Nasdaq. The Russell 2000 for small caps hasn't broken out yet, but as you can see, there is a slight upward bias. So certainly small caps are not weakening. And the point here is that this is not a market that's being driven, the main indices are being driven by just a handful of big tech stocks. That is not the case at all. This is still a very broadly based rally. Let's take a look at the German DAX, and we'll take a bigger picture look. The German DAX is an index that tends to, once it starts to trend in a channel, it tends to trend in that channel really quite well. And you can see this period here from September 2011 through to about April 2014. So about 2 3/4 years, the market trended higher. We then got into a corrective period from March of 2015 until about a year ago, and then you can see that the index basically broke this downtrending channel. This downtrending resistance line. We broke out, we came back, we retested that breakout, mucked around for a little bit longer, and then took off. And you can see there's quite a lot of similarity in the angle of the 200-day moving average compared to what we just looked at on the S&P, and they really do mirror each other quite well. So the German DAX is at all-time highs. We have broken out. So if we put a trend line across here, so again, we've broken above this peak. We've come back, we've retested that breakout, and now we're off again. And with economic conditions in the Eurozone definitely on the improve, the only expectation you can have is that the German DAX is heading higher. There's no other interpretation of what's going on there at the moment. Let's look now at the FTSE, and similarly, we've got a breakout here. These are all-time highs. Again, we've got the same sort of pattern here, where the market ran up to resistance in October of last year, pulled back a bit, managed to break resistance, came back, retested it a second time, and now I think the FTSE index is also heading higher from here, and that's despite all the concerns about Brexit and the impact that would have on the UK economy. Basically, stocks are heading higher. Now the US dollar was, of course, the big story, and let's just zoom in and have a look at the last little period, so you can see Friday night, or about a week or two ago, the index broke down in late June. But we were getting a bit of a consolidation period here around support, but broke down quite badly on Friday night when that economic data came out. So if we pan back to see where the US dollar might go, you can see there's some very clearly defined channels here. This was the 38.2% retracement of the whole run up from when the US dollar index was down just below 80, ran up to 100, and we then formed these lows and a support level down here around 92. It would appear that the US dollar is now heading back to 92. It's currently at 95, and that's a pretty steep rate of descent, and you can see that it's finding it very difficult to bounce above this 20 period, 20-day moving average. So I suspect that the likely outcome is US dollar lower for a bit longer, and then I would expect that we'll probably see a pretty strong bounce. Now, as a consequence, the Australian dollar has firmed quite a lot, up 2 cents in the last week, which is getting up towards a 3% increase in a week, which is a lot. But if we look at the bigger picture trend, you can see that it's really still within this basing pattern. And it could also just be a sideways consolidation pattern before we get a continuation of the downtrend. Now, at the moment, it's just fluctuating above and below the 200-day moving average, which is just basically flat. So that's the bigger picture perspective. When we zoom in, we can see that the Australian dollar really did have a very powerful week from 76 up to 78.3. So I'm no currency expert. I'm just looking at the chart patterns, and it's certainly the Australian dollar in the short term is showing strength, but I maintain my view that is also shared by, pretty much most economists and most of the rational commentators, and that is that the Australian dollar, based on fundamentals, really should be somewhere below 70 cents. And the expectation is for that to occur over the next 6 to 12 months. And I really don't see any reason to change that view. So turning now to the Australian market, the Australian dollar up above 78, as I mentioned. Our index finally had a good solid Friday instead of selling off. And the index managed to hold a 62-point gain for the week. There are some isolated good news stories out there in individual stocks. Percentage-wise, there's not that many of them, and just far, far less than overseas, particularly in the US market. But there are some isolated good news stories, and as members will know, we've managed to get on board a couple of good ones of late. Precious metals. Gold was actually up by $16 to $12.30, and we also saw a rebound in silver. Silver had got down to an oversold level, formed a double bottom, and rebounded. But I've got to say, I don't have a great deal of confidence about the whole precious metals sector at the moment. It's just not behaving the way that you would expect. With the US dollar declining as sharply as it is, with events around North Korea, it's really very, very unexpected that gold would be behaving in the fairly weak fashion that it is. So I don't have much confidence about the sector at the moment. Now, the GLD holdings in the ETF were down about another 5 tonnes, down to 828. So it's not a stampede out of the ETFs, which is a good sign, I guess. Precious metal stocks really still pretty much becalmed. There's really not a lot happening there. So let's take a look at, first of all, silver. So this was our double bottom down here. In fact, really you could say it's probably a triple bottom across here. And we've got quite oversold. And as you can see, every time we get down to these levels of oversold, there's generally a pretty decent bounce. How far this follows through is the unknown at the moment. But as I said, I don't have a great deal of confidence because it's just been reacting so poorly to circumstances that should have been very positive. Looking now at this is gold on a weekly chart. So we're still constrained by this big picture downtrend, which started in 2011. So we definitely need to break above 1300 to feel that we're getting some more positive traction back into gold. And there we go. I'll take this trend line out now because it's really no longer relevant. And we know what happened around the last Fed rate hike. So we've actually come down even further around that rate hike, but quite a nice strong bounce on Friday. So if we go to GDX, again, really nothing much happening here. This has just been one big consolidation pattern that really started back in October of 2016. Other commodities, copper up to 267. That's really just going with the currency. Crude oil bounced to 46.5, and that was partly due to a fairly decent drawdown in crude inventories. So that was seen as a positive. And of course, the US dollar impact. Stocks bounced a bit. Energy stocks bounced a bit, but really nothing to get overly excited about. There's our spot copper chart, and the oil chart I'll have for you next week. Now the current positioning, my message is simple as it has been now for several years. Stay with the trend. Those who are trying to pick tops, who are fearful of being caught up in the next correction, have been left with lamenting with empty pockets if you've been staying out of the market. So stay with the trend, shut out the noise of the media and all of the people that want to make themselves a superstar by calling the next top. Eventually they might be right, but that top will come from some extremely higher level. How to approach the next few months? Look, I'm not saying there'll be a pullback because I'm not getting into predicting the market actions in the short term at all. But psychologically, you must allow for a mild pullback, and by mild, I'm meaning 3 to 5% in the major indices. But you should only allow for it. I wouldn't really let it get in the way of your game plan, because there's just too much money to be made, too much profit to be made by being in this market. And the other aspect is that the strongest sectors may not decline. The strongest sectors in the US, which are centered around technology in all its various forms, Chinese internet stocks, financials, healthcare making a bounce back. These sectors may not actually decline with the overall index. So, why would you want to shut yourself out of the market just to try and avoid a little bit of downside? So there is a method for getting into markets that are just continuing to go up and up and up. You don't just jump in at any old time, and I cover that very, very frequently. So as long as you abide by that methodology, then really you should be participating in this market with your ears pinned back. There's my contact details for non-members. It's all positive at the moment, and I really think it's an environment that will continue to be positive for stocks for the remainder of this year. So that's it for this week. Cheers.